Hello and welcome to another amazing episode of the Accredited Investors Only podcast presented by Accredited Life. I am your host, Peter Neal. Thank you so much for joining me again today. We have a really great show lined up with a really amazing guest. Before we get into that, it's been a little bit since I joined you in the beginning of the show to talk about living the accredited life. I'm sorry about that. I have been living my accredited life. I've been very busy. But I really wanted to get back on and provide some tips and things like that on how to live your accredited life. So let's get back into that. As I've like to ask, are you living your accredited life? I just got off of a different podcast interview, and we talked a lot about getting started, for investing. For accredited investors, somebody who's working full time, enjoys what they do, and is looking to get involved in the passive side of investing or even the active side of investing, but maybe is stuck, or is kind of has the analysis by paralysis working. And we talked about how like that's not really a real thing at the end to the day. I mean, it's real in the sense that it happens to people, but the reasoning behind it and all, it's just, are we really just kind of making excuses, to kind of procrastinate at the end of the day? It's another way of talking about procrastination and not getting off the bench and getting into the game and taking some action. And we talked about how can somebody get over that? How can they get over that hurdle? And really, it comes down to confidence at the end of the day. Confidence is what allows us to get through the analysis paralysis, kind of get off the bench and get into the game. And how do we gain confidence? It comes through information. It comes from being informed. It comes from knowing to some degree what you're doing. You're not going to know everything, obviously, up front when you just get started. But you got to get into the game. You got to start playing, and you got to start, talking to people. That's really where it's all. That's where the magic's going to start. So things like this podcast today, and all the previous episodes we've had, and the episodes we have coming up for you. Great resources to listen to myself, listen to the guests, listen to the different strategies that they're doing in their life and in their business. That's a great way to build confidence, to start to understand and be more informed. Reading books, listening to other podcasts, all that kind of stuff. Things that you can do in the privacy of your own home, in your car, while you're out for a walk, or you're walking the dog, you're going to the grocery store, something like that. All that kind of education, all that stuff that you're consuming is going to help you to gain confidence. But that can't be the only thing you do. You have to network. You have to go to meetups, go to conferences. You have to go on LinkedIn and go listen to these podcasts and reach out and talk to people. Reach out, have conversations, and from there, you got to even take it one step further. You have to be interested and curious and learn to ask good questions, so that you're not necessarily bothering somebody, or because you don't want to just be trying to suck information from people without trying to add some value and things like that. So it always comes back to knowing yourself, having that life assessment. If there's some way that you can add value, some way that you can, benefit the person that you're looking to gain information from as well. That's helpful. I don't think it's 100% necessary. People come to me all the time and ask me for different things, and I don't ask for anything in return. But there's always a point. You know what I mean? There's only so much time you can give, especially as an entrepreneur, as somebody whose time's very valuable. There's only so much time you can give. And believe me, I do this all the time. There's some people where they don't have the time to give. So if there is a way that you can try to add value, if you can find that, that's wonderful. If not, just being interested, being curious, and when you do ask questions, asking the right questions, and I think the best way you get out of that is when you're kind of moving in both directions. So when you actually have things going on, not just kind of asking these general questions about this and that, but when you're actually researching a deal, or you're researching an operator, you're researching a market, all that kind of stuff. If you have an asset class, you name it, if you have something a little bit more specific, something a little bit juicier, a little beefier, that you can ask specific questions and gain then specific answers and knowledge from that person, they're going to take you more seriously. You're probably going to learn something a lot better asking that way as well, and that's going to lead the conversation in different ways and all that kind of stuff. So that's my piece of advice today. If you're stuck, if you don't know what to do, even now, there's a lot of changes in the market. If you're kind of looking for the next evolution of your investing career, now is the time to, of course, be consuming information when you can in your free time, that kind of stuff. But also make sure you're networking, make sure you're having conversations. That's how you're going to gain the confidence and the information to be informed and all that kind of stuff. That's going to lead to actions, going to lead to those next steps in your life and in your investing career. So, without further ado, that's how you live your accredited life, right? So without further ado, we have an amazing guest on the show today with a really great interview lined up for you, Michelle Jeong. She is the founder and managing partner of Fire Capital. She started that in 2017, and it's a real estate investment company that balances purpose, people, and profits. And she acquires existing Class B and C multifamily properties and renovates them to create value. She leverages a unique people-first approach, which is so important in this business, where she focuses on offering safe and clean, affordable housing to working families while providing strong financial returns to her investor partners. So without further ado, let's get right into the interview with Michelle.
You're listening to the Accredited Investors Only podcast, presented by Accredited Life.
Michelle, welcome to the show. How are you feeling today?
Great. Thank you so much, Peter, for the invitation. And hello, everyone.
Well, I appreciate you being here, Michelle. Why don't we start with you introducing yourself?
Absolutely. And thank you again, Peter. My name is Michelle Jeong. I am managing director and founder of Fire Capital, based in sunny California, specifically the San Francisco area where I was born and raised. So a big shout out for anyone in the Bay Area. However, I've also lived all over the country and the world, and I am very lucky to have found my fire, which I started Fire a bunch of years ago, focusing full time in multifamily, affordable, and workforce housing space since 2017, and I have about close to 1,000 units under management. So it's been a fun ride. Thank you.
That's awesome. Well, anybody that knows me knows I love affordable and workforce housing, so I'm very much looking forward to this conversation. But maybe let's start, kind of in the beginning. When were you first introduced to real estate? It sounds like from some of the conversation we were having before that real estate maybe wasn't the first thing you did. You worked in finance, or tell me about that.
Yeah, absolutely. So my background, I guess I'm going to date myself a little bit, but I started in tech in the 90s, right after graduation, graduating from Cal Berkeley. And I was in and out of tech. I am a serial entrepreneur. I got my first taste of real estate in 2009 when I purchased my first small multifamily here in the Bay Area. And I did the baptism by fire. I learned the hard way, all of the, dotting the I's and crossing the T's when it comes to rent control in the area. So, which for many of your listeners, you may know that it's one of the most draconian rent control markets in the world. So I developed that thick skin, so to speak, from that experience, and it's been fun since. Before that, though, I transitioned. I was a techie. I believe your prior call speaker, Ed Matthews, was also in tech.
I was going to say that a lot of real estate people are, especially accredited investors. I feel like there's just that industry breeds a lot of accredited investors, and then people are looking for alternative investment vehicles and things like that. What led you to real estate? Was it in the family? Did you have a friend or something? Like, what was kind of that? What made you want to bite the bullet and get involved in that?
So really, I'll be honest, it was because I was burning the candle on both ends. Um, I love tech, don't get me wrong. But I transitioned out of tech because of the time involved, my personal versus, work-life balance was non-existent. I was sandwiched between being a single mom of two
Mm.
young girls and also taking care of my parents. And there was only so much working 60 plus hours for tech startup as one of the founding team members. Um, it wasn't sustainable.
Wow.
So it was one of those come to Jesus moments. I know that Ed talked about a little bit. He realized that his W-2 was making less eventually than his passive income. There's that there's definitely that element to it. I think for a lot of techies, a common experience is that also the AMT taxes that we're forced to pay on unrealized gains on stock options that we don't know will really, hold their value.
Mm.
We're paying in real time, in real dollars for
Wow.
something that is just a promise. But really, for me, it was more of a personal choice. I was looking for that flexibility. My mom was going in and out of that hospital. I was working 60 plus hours a day. Real estate for me was a way out. It provided the greatest flexibility to be there for those that matter and do something that matters. So allowed me to also build long-term wealth and legacy wealth for my children. So really the name FIRE stands for, many people think it's, the FIRE journey, the typical. Well, for me, that FIRE stands for freedom, financial independence through real estate. And that's what I wanted to share with my investors. That's what I want to share with your audience is helping them achieve their FIRE.
That's awesome. I'm sure there's a lot of people that can relate. And I saw that on your website and I thought I really like that because, yeah, at first I wasn't sure. Yeah, I was wondering if curious when you hear a name like that, you're curious. Oh, I wonder where that came from. And then seeing that on your homepage, it answered the question right away. But I wasn't sure if maybe you came up with that afterwards or something. But it's cool to see that that's really embedded in your brand and all. Yeah, I love that kind of stuff. So was this a gradual transition, or did you kind of jump right in, or yeah? Because I'm sure I know there's a lot of of my investors and audience, people that listen, that could relate to this story, and it's always some people jump right in, they say, okay, I'm going to do it. Others, it takes time, and I think Ed was one. I think where he it took time. And he bought some properties, that kind of thing. So curious to, what was your transition like, and what kind of challenges did you face, or how did you get in the mindset, all that kind of stuff?
Yeah, so, it went in like spurts, I would say. It's not just an eventuality. My first acquisition was a small apartment building, 2009. I'm not afraid of old vintage, especially for many of your listeners who are living in Boston, for instance. Those brownstones are in great neighborhood, but they're very old.
Hmm.
San Francisco, you have the Victorians. They are old,
Yep.
but they're in some of the greatest neighborhoods. So, um, it's like that was my entry point. But that from 2009 to 2017 is a long time.
Mm.
I am like yourself, where you focus currently on single family homes. I might want to convince you to transition to multifamily, but with me. But I started with single family homes myself. My idea of focusing on workforce and value and affordable housing
Mm.
personally because I as a firstborn generation American, with my parents as immigrants, they came from nothing. They achieved their American dream, and they we were working class, we were a working class family. Those are my roots. So being able to focus on this space is going back to my roots. It's really, really important for me. I know how hard the families work and how much they need safe, clean, and still affordable housing. Wall Street Journal, there's or the Poverty Report, whichever report or recent research you look at, it ranges from 3.6 million all the way to 7 million in units that are in need of
Sure.
in that space alone. So that's why I feel like going in and trying to provide a product in which a home not just a product, I correct myself. It's a home, really, to those that are definitely in need of this is my way of giving back to this country and to this community.
Yeah, no, I love it. I think it's more than an investment. You know, there is that impact to it, and it helps it helps to drive, you know, the daily grind that comes along with real estate investing. And I always think it's nice when you can have like a kind of a greater picture, you know, and a greater story, and just an overall greater impact than maybe, you know, some other types of asset classes and things like that just don't necessarily come along with the social impact that affordable workforce housing comes along with. Now, I know people working in this space, a lot of people have their own definitions of what it means. I'm curious, when you say workforce and affordable housing, what comes to mind? What do you think of, like, from a price point perspective, all that kind of stuff?
Usually, when you say price point, are you referring to rents per month?
I'm assuming, yeah, for because you're in multifamily, you know, I'm
Sure.
assuming it's going to be based off of kind of rents, that kind of thing, or
Correct.
yeah, and then I'll be probably area, location, and demographics of the client, yeah, of the tenants, that kind of thing, are going to all kind of factor in. But yeah, I was so curious,
Yeah.
you know, to just so I can get a mental image of, you know, when you say workforce affordable housing, because I think too in different areas, you know, like California, what's affordable in California is luxury in some of the, you know, Baltimore or Philadelphia, right? In some of these areas.
Absolutely. So this is where you're asking me a macroeconomic perspective. And I actually, my background is in economics, so I can definitely talk a lot about the indicators that I look for.
Great.
So I definitely look for, in general, they're known as Class B and C assets. So I definitely focus on Class B and C assets and Class B and C neighborhoods. So we're not talking about a lot of the, I know, millennials and Gen Zs. They've been focused on really, really nice Class A luxury units, or yeah, residences with the dog washes and
Mm.
the trash concierge and things
Yeah,
like that.
cool.
Yeah, and I'm not looking for those. There's a glut of the Class A product out in the market.
Sure.
We see across the country. In fact, Austin, for instance, has a 15% vacancy in just Class A alone. What I'm referring to are for those that are in the median household income of each of those markets. So,
Mhm.
and you're right to point out the fact that California median income is much different than that of Baltimore, for
Mhm.
instance. Um, so what I look for is a minimum of 50,000 median household income or higher, because obviously, as investors, we want to make sure that people can afford their rent.
Sure.
We also look at areas that have a really, really high home value, like especially an increase of home value from
Mm.
2020 to 21, because that means that there are also going to be more renters than there are homeowners,
Mm.
right? It's
That's a
like
good
a
point. Yeah.
inverse relationship. I look at rent growth, for instance, when I look at difference. So I'm looking at something that is meets the national average or beats ideally the national average of job growth. And right now it's anywhere from it's dropped a lot in the last couple of years. So right now it's like 1.2 to 2% job growth over the last 12 months.
Mhm.
I also look at other indicators such as job growth, which you could pull from freely, and all this information is for free, is through the Bureau of Labor Statistics. I look at crime.
Mm.
Uh, None of us want to buy or invest in high crime areas. So I definitely look at the crime stats.
Yeah.
Before I put down an LOI, my team and I look at all of those macroeconomic trends before we make a move.
Yeah, I think that's really important, and probably one of the biggest misconceptions when people hear workforce affordable housing. There's definitely a percentage of people that think war zones, and I'm always telling people, we're not investing in in war zones. Not that there aren't investors that focus on that and do that, and I'm sure can make a living doing it. But that's not what workforce affordable housing is, and no matter like what kind of definition you look at it, that's just not, most investors don't want to invest in those types of areas and for a number of reasons, so,
Yeah, I
uh,
wouldn't.
Yes. And I was assuming so, because it's just you tend to not see syndications and offerings based on that. That's usually smaller, local mom and pop type investors, and contractors and things like that who tend to operate in those areas where it's only really investment sales going on, and you're probably not going to hit any of those of the demographics you were just listing there, from a property values and rent growth and all that kind of stuff. So it's just a totally different universe, and I think it's very important that people understand the difference between, like that's like class D, at that point, and even maybe lower than that. So, are you investing? So you're based in San Francisco Bay Area, but it sounds like you're investing. Do you have certain markets that you like, or are you kind of all over the place? Or talk to me about that.
No, I'm invested in about 9 different states. A lot of it is in the Sun Belt, for instance, although I have a couple of investments in the Midwest. I have 2 active deals right now, one in Tyler, Texas. Just
Tyler, yeah.
don't know. Yeah, for those who don't know Tyler, it's not far from the Dallas Fort Worth MSA. It's a really fast, very, very solid market that's seen a lot of great gentrification, a lot of growth, both from the job side, but also development,
Mhm.
population increasing there. And they have a really nice, funky art
Sure.
twist to that. I've invested in, for instance, Lubbock, San Angelo in Texas as well, um, Louisville, Kentucky, and I also have a deal under contract for one of the smaller campuses of UNC, which is going to be amazing. Um, so North Carolina, a lot of growth there for those listeners out there who might be interested.
Wow. So are you working? I'm assuming you're working then with third party property management in those areas, or yeah, talk to me about how you're operating your deals, that kind of thing.
Absolutely. My team, I partner with, as part of my team, my lead asset manager who's been doing it for many, many years, who also has experience 20 plus years in forensic accounting. So you know that she's going to look at those numbers really closely. Each deal we have, which I very much involved. We have property management calls every week, asset management calls, and then, general partner calls every week per property. So we truly have a pulse on the ins and outs. I might not know the very specific name of a particular tenant, but I certainly track those numbers on a weekly basis.
Mm.
We've set up tapping into the Techie and Techie and I have developed systems in place as well as tools to do a lot of the analysis
Mm.
for to make sure that we're tracking those numbers according to the underwriting and the property management budget. I'm big with data, I'm big with numbers, and making sure that we over deliver for our partners and for ourselves because we don't get paid until they get paid. So um, that makes us very much aligned with our partners.
Wow, that's yeah, I love a structure like that, and I'm sure a lot of investors do. So talk. Are you primarily working with brokers? Yeah, talk to me about how you find deals, especially when you're working in so many different markets. Curious to what the strategy is. How if it's mostly on market deals, off market deals, combination of both. And then how do you talk to brokers? And do you have somebody in house that does that stuff? Or are you doing it? Or curious to how you have that structured.
My team, one person has been, I'm actually an extroverted introvert. I like doing the
Awesome.
analysis. I like doing, creating the action plan and business plan and delivering. There are other people that have that absolute skill set who love talking, and kudos to them. Thank you. Um, and they are the broker relations. They start generating both market, off market, and listed properties, and we make sure my underwriters go through it. I'm very conservative with my approach. And yeah, so when we do conservative underwriting, we work sometimes, and oftentimes we're not the highest bidder. In fact, we haven't been the highest bidder, but we're the ones that can close.
I like that. I like the term broker relations. You always hear investor relations, but I don't know if you heard broker relations. I think that's so important. Because a lot of times, especially depending on the size of companies and things like that, your relationship with brokers and their ability when they have a deal come up to think of you is extremely important. So yeah, I love that title. I don't know if you've heard that before, broker relations. Everybody should have a broker relations person on their team, depending on what their strategy is, that kind of thing. Okay, so you find a deal, you're bringing it in house, and it sounds like you have a pretty strict underwriting, kind of process, that everything goes through. What are some of the things you look for? It sounds like you're more on the value add side of the spectrum. You want to see some physical and operational value add. What are some things for investors? Our audience is more on the passive side. So what would you say when they're analyzing, deals from a passive perspective, and they're looking at the pitch deck and they're looking at kind of the business plan? What are some things that get you excited, when it comes to we're going to be able to create value here?
I definitely we do a lot of research in terms of comps, market research on the ground. We secret shop. We look at all of the competing comparable. So we're not going to do a comp of a Class A property. We might,
Sure.
might not, but we try to do an apples and apples comparison of B and C properties because those are our true competitors. And we find out, what type of services and amenities they provide, what type of what it might be their vacancy rate, what are their market rents, etc. We also look at the CoStar. We look at a couple of other sources behind it, and then we kind of pull it all together so that we have real backed up data on rent comps. Look at obviously the cap rates. A lot of it is pulling data from different areas. Then we look at we look at the property size, et cetera, and what we can do, what we would have to do in the first, 3 months. We do it on a quarter by quarter plan, especially in year one, because there's a lot of stuff that you will uncover upon acquisition that you didn't know about, right?
Sure. Yeah.
All know about. So you're like peeling the onion a little bit on what is real versus what is like on paper.
Yeah.
So there might be some extra need for extra reserves in case you have to evict more people than you expect. Bake that in. I always bake in extra reserves, what I call, can I swear or use a?
Sure.
Okay, I always build in things like the WTF funds.
Yeah, exactly.
So especially if you're talking about a stressed asset, which a lot of us have seen enter the market in the last, year and a half, which I do definitely predict there will be still more to come in 2025. And in those stressed assets, you definitely need to bake in a lot more reserves. So if you're normally baking in 2 months, you probably should double that because it might take you longer to clean the property up. Definitely do your due diligence. I call it, sorry, I'm going to be very visual here, but I call it a property enema. So
That paints a mental image.
and you're going in and you're checking every single property. We check in every single unit.
Every unit, yeah. Wow.
We check every single unit. We flush every toilet. We check every single appliance. We find the age. We check to make sure they're working. We create this huge database of everything. And then we obviously share that with our property management company. So on day one, you already have a planned executable action plan on what you're going to renovate, exactly which unit
Sure.
and time period and the cost. You have much more accurate hold of the cost. So we really go in, and if for me and my perspective and my approach is that if you do the heavy work up front, you're going to save so much time and energy and speed for ourselves as a team when we absolutely have to execute and we close.
Yeah, that's a really good point. What's the size of the properties typically? Like, how many units are we talking?
Well, for instance, Tyler is 152 units. Uh, then the other one is 108 units.
Okay, okay. What would you say your typical buy box is? Like, would you go under? Do you want to go over? I mean, what usually justifies, the property management and maybe I don't know if you have any on-site staff at that level. You probably I would think you could justify it.
Definitely.
So,
So so again, depending on the condition of the property, for instance, there are two properties in Texas that have 92 units each, and we'll have a full-time property manager. We'll have, for instance, at least one full-time maintenance. Maybe actually on the last acquisition in Texas, we actually have 2.5 folks on the maintenance staff to help with the turns because it made a lot more financial sense to bring the HVAC in-house, the plumbing in-house. It helped with speed and cost and savings and for everyone. So we were able to maintain a higher level of quality control.
yeah, that makes sense. Wow, flushing every toilet. I could. The broker probably loves you. When they have to,
He does.
when they have to schedule that, but because I've got experience in commercial brokerage and I've been on, the teams of selling some multifamily properties, and it does boggle my mind when people will go through and, they'll visit like 2 units in a 100-unit complex, and you just think like there could be some nightmares behind. It's like a game show, what's behind door four, it's just like I do love that kind of taking that stance, because I think it's important, and just like you said, it's I'm not a fan of surprises, and I think that does certainly help to eliminate some surprises as much as you possibly can, right? There's always going to be things that come up, but yeah, that kind of thing. So wow, okay. So how do you find the best property management companies to work with? I'm curious. What is that interview? I'm sure it's an interview process, right? You got to court them in some way.
It is.
How does that work?
So we always reach out to about 4 to 6 property managers, and they're everything from referrals all the way to those that we've already had pre-existing relationships with. And
Sure.
I would say, just as a tip, for those who have had that same struggle in terms of choosing property management companies, the biggest is the boots on the ground, because they're the ones who are going to execute on your plan, and they're the ones you're going to be responsible should be accountable to the success or the failure. And always another tip is have a plan B or plan C thing. So just in case, so if you have an ideal pick, make sure that you interview just as extensively the other three, so that if and when, because they're not if, it's when you need to go and revisit because they're either not meeting your budget needs or they're not meeting your action goals, you have to revisit.
Yeah.
It's just, you just have to. But really, I would say that especially in the larger commercial space, the regional is going to make or break your deal just as much as that property manager.
Yeah, that makes sense. Yeah, because that was I was curious too. Like, is there a certain size of the company that you look for? Because sometimes if it's too small, they might not have those boots on the ground where they're subbing out everything compared to having some in-house staff that's dedicated to work, just them, that kind of thing, and they have more control over the people that work for them versus a larger company where you could become just a number,
Yes,
exactly. Yeah.
So no, you bring up a really great point. I would definitely comparable. Someone who has deep experience in Class B and C assets in affordable housing. If, for instance, you are in LIHTC, so that is basically restricted for those who might not know. It's e- every county in every state has a certain LIHTC asset, which is basically kind of like rent control.
Hmm.
It helps allow lower income, lower it stands for lower income housing,
Hmm.
and percent has to meet like 40 to 60% average median income. So you're restricted to your property. If you have a LIHTC property, you want to have a property manager that's very, very good at tech properties. Um, you focus, for instance, Peter, on single family homes. Well, I'm not going to have a single family home property manager
Hmm.
who may be a rock star in what they do in the single family market, but if I plant them into the multifamily, they may be in over their heads.
Hmm.
S You really want to make sure that this property manager has a track record in the space that you're operating in.
Yeah, that makes a lot of sense. I know that was one of the questions I was going to ask, and I guess I kind of made the assumption you were doing market rate. So do you deal with? It sounds like you do touch properties that have, subsidies connected to them in some ways.
Yes, sometimes,
Gotcha.
quite a bit, and, I would also say that in choosing property manager, for me, this is my own philosophy, and that I share with my asset manager and a lot of those people that, are part of my team, is that we really believe in people, profits, and purpose,
Mm.
and we take a lot of um one of my partners will hopefully will be smiling listening to this podcast, but we really believe in the concept of taking a complex and transitioning them over to communities.
Mm.
And so we work with property managers that buy into that belief and are willing to launch and develop monthly community programs with us.
Mm.
And so they can be really little. I mean, when you're dealing with workforce and affordable housing, they are thrilled to pieces that you're offering, different programs, different raffles for doing the right thing.
Oh wow.
Y- If you pay on time, you get a raffle ticket and your name is entered into that raffle ticket for a TV.
Okay.
No. It's NFL season, so of course they're gonna want that big
Yeah.
size TV.
Yeah.
Um, we do things like Halloween and dog dress-up contests and
Yeah.
ultimate. I mean, just small little things. We give away school supplies during, back to school events. So these programs really communicate the fact that we care.
Mm.
This is not just a number. They
Right.
are they are a resident, they are a guest, they are people.
Yeah. I think that's a really, really great idea. And, like you said, it builds that community and, it just makes it more of a home, and not just another apartment that you're living in or something like that. That's a really great point. And something it builds the community. It's good for, that part of just, you know, people living there and that kind of thing, but it's good for business too, I'm sure. It's going to help with occupancy rates and things like that, and the building starts to get a reputation, and people want to live there, and also it's a win-win.
Absolutely. I mean, definitely referrals, vacancies, renewals. I mean, you go down the list of the KPIs and you're hitting every single aspect. And for what? For small investment up front.
Hmm. Yeah.
So the domino effect is massive.
Yeah. Yeah, that makes a lot of sense. Now, one thing you said too was, how you're looking at the data and the comps and things like that. Where do you typically want to land on the comp spectrum? Do you want to be on the higher end? Do you want to be more in the middle, or what's that? Because I feel our concept with workforce affordable housing is, and we've pushed it before. You know what I mean? Like where you start to see, prices go up in the market, and you think, oh my God, look at this. You know what I mean? So and you have luck, you put the number out there, you get it, and things are great, and then a few months go by and you start to see, that we're not paying on the first now we're paying on the third or the fourth or the fifth. and things start to slow down, that kind of thing. So it's one of those things where it reminds you sometimes the importance of not pushing, the limit. So I'm curious how you factor that in and where you want to be in relation to the data that you're seeing and all.
So, to answer your question, uh, it really depends on the whether we're offering a classic product that we renew when we fix,
Mm,
or we're offering
sure.
a premium platinum product. So, which are complete gut renovation with, stainless steel's appliance, smart thermostat,
Mm,
nice final planking, extra amenities, things of that nature.
yeah.
Um, so for the classics, we tend to be extremely competitive.
Mm-hmm.
We're definitely not the highest in the market. We want to be the best value,
Mm-hmm.
and we're always by tracking the trick and the sweet spot about tracking the competitors was we know where our sweet spot might be.
Mm-hmm.
So those classic, the people that are attracted to the classic units are going to be much more price sensitive,
Sure.
for instance. But the premium, you know, uh, will offer at market rate, for instance, if we can.
Yeah. Yeah. And that makes a lot of sense. And I'm sure there probably, I don't know what market would have a lot of that type of product. I mean, so I would think there's definitely low supply for that type of product and high demand. Pretty much no matter where you're at in the country, there tends to not be a lot of newly renovated, where you have all those kind of, higher appliances and finishes and fixtures and all that kind of stuff. So that makes a lot of sense. Another kind of a question that comes to mind is that after the last few years with interest rates and things like that, where do you see the future? I mean, are you excited about 2025? And I mean, I think yesterday, as the time we're filming, this will be released a little later, so we'll see what happens when it goes out. But I think yesterday was like the highest interest rate day in the last 9+ months or something like that. So where do you, inflation seems to not be slowing down as much as maybe was expected, all that kind of thing. So what's your outlook for 2025? What are you excited about? What are you maybe a little concerned about?
I I couldn't have paid you to ask that question. I actually just every year, I do a huge analysis, like a holistic analysis, both political and economic trends,
Mm,
and I create something called, the fire crystal ball, which
nice.
if you go to my website, Investing with Fire, and sign up, I'll make sure I can send you and your audience. I'll send you, and you could
Okay.
share it if you wish. But
Great.
I just published a 5-page white paper on my
Yeah.
prediction.
Nice.
I'm really, really, I'm really positive on the multifamily outlook in general.
Mm,
Um, you brought up the interest rates. I think that big, a lot of people were banking on uh, more aggressive cuts
mm,
to the Fed,
yeah.
to the rates, and the 10-year yield and that's gone the opposite way.
Sure.
Um,
That's gotta scare some people in all these pref equity deals. My goodness, there's been so much pref equity deals in the market, and I'm assuming I don't follow it as closely as maybe I wish I did, but I'm assuming a lot of them were banking on rate cuts and being able to refi and get that, some in some cases super high interest rates out of the deal, out of the stack as quickly as they could. So I'm assuming that's starting gonna start to hurt some people.
Yeah, I mean, it's been hurting a lot of operators, a lot of syndicators since basically 2022, if you must be honest with the 2023, 2024, we've all gone through a big roller coaster ride. Um, I like boring. I said this
Yeah,
I
I
said
say that all the time. Yeah.
but I will say it again. I mean, boring is the new sexy.
Yeah.
Me a boring loan. Give
Yeah.
me a boring, assumable loan,
Mm,
based agency. Um, the Tyler deal is exactly that. It's predictable. We're going to get it at, it's 4%.
mm.
Um,
That's
Blended.
great.
rate for the life. So it's
Wow.
predictable. There's no need for caps. There's no
Mhm.
surprises there.
Yeah.
Um, I truly believe in boring. Those when it comes to loans, boring is the new sexy. And the Fed rate, when you buy assumable loans and you have that niche, you don't care really what the Fed's going to do because you're locked in.
Yeah.
So that's great. You're sleeping well at night.
Yeah.
Um, I don't like to worry about my investors' money and where they're going if I'm getting myself in a messy loan.
Yeah. Yeah. I that's one of the things I love about the single family side is the lending is much, yeah, with a 30-year fixed rate loan, you know what I mean? It's a 30-year AM, 30-year fixed. You can't beat that. And I think, and I wonder if you agree with this. I feel like in a lot of ways, workforce affordable housing is insulated from a lot of the craziness in the market. Now on the commercial side, if you are utilizing floating rate debt and and it's coming due every couple of years, that kind of thing, then that maybe doesn't insulate it as much. But just the sheer undersupply and the demand, yeah, and that's pretty much in every market, but especially in certain urban and suburban markets, where there's just crazy high demand. We're not producing more units. You know what I mean? Like you said, a lot of the new product is Class A, and yeah, it does affect the overall market. You look at data and all. If there's a ton of Class A new development, it affects rents all across the board. But at the end of the day, when it comes to affordable workforce housing, we're not creating more of it. And I know the numbers on the single family side, it's like less than 2.5% of new homes built were valued under 250,000. Yeah, so it's just like,
Yeah.
and even so, like on the multifamily side, you don't see a lot of that product coming online. It's always the smaller percentage of new product that comes online, that kind of thing.
You're absolutely right. I mean, if you look at the trends, there is such a need for this particular workforce and affordable housing. I mean, you have more renters staying in places for longer and renting for longer. You don't have enough of supply, which we talked about earlier in the on the call. 3 to 7 million units are needed in this space alone.
Yeah.
And when the average home price is close to 417,000
Yeah. Hmm.
nationally,
Hmm.
buyers have to earn 115,000 or to qualify for a typical home.
Yeah.
A lot, let's be honest, a lot of people don't make that much money.
Sure. Yeah.
So for all, for so many of these reasons, you've got the lack of affordable housing to purchase, you've got higher, more renters and therefore more demand, not enough supply. You don't have to be a rocket scientist to know that we have a big gap that is needed to be filled, and this space is just, it's a diamond in the rough.
Yeah. Yeah. I think over time, you're going to see more and more attention towards it. It takes time for investors, from an active and a passive, realm, to move where they need to move. And when you look at the data, and I'll send you some stuff because it might help with presentations and things like that, because I've done a lot of that research. And you look at the data, workforce affordable housing, uh, over the last 20 plus years always has outperformed every other asset class, retail, industrial, market rate, office, you name it. So, and a lot of it just has to do with the sheer consistency. And if there are, as if there is a downturn or something like that, the pool that's already huge of people that, are looking for those types of units only gets larger. So I think now more than ever, investors need to start to wake up to it and look at it and have a percentage of the portfolio in that space, because I think it provides a lot of benefits and hedges against maybe some of the other stuff that they're doing.
Well, and let's just talk about, all of what you just said is beautiful, but let's talk about taxes.
Mm.
If we look at just taxes in general, I mean, that's the fun begins. I mean, you have to have a strong approach when you're dealing with, building wealth and legacy,
Yeah.
just not just the investment side, but also the asset protection side. As you know, and you've been giving great, you've had a lot of great people and asset planning, et cetera, invited onto your podcast. And So I'm just preaching to the choir here, but really, especially with this new administration next week,
Yeah.
uh,
It's right around the corner.
right around the corner, we know that there was a failed attempt, and it was bipartisan in the Congress to pass to pass and revise the bonus cost segregation. I'm
Mm.
sorry, the bonus cost depreciation.
Yeah.
I'm getting the names wrong, but
And I know what you mean.
Bartolds. But with that, they believe it's going to go from, instead of stepping down, it's going to be go back up to 100%.
Yeah.
And with that, I mean, wow, we're talking about serious tax savings there.
Yeah.
So for that alone, I mean, I can tell you, I will be having an announcement this week with some investors, and they are going to be so happy
Mm.
hearing how much they're going to save in their taxes
That's awesome.
for. So, yeah,
Well, you bring up you're excited too, right? You bring up a good point, just from a wealth and planning and all that kind of stuff. What would you say your long-term goal is? I'm curious. I always curious for in apartment investors whose typical deal is 5 to 7 years, and they kind of rinse and repeat, that kind of thing. So I'm always curious to what's the long-term goal. Like are would you ever want to refi and continue to hold? I'm sure there's some benefits to that. And then maybe some drawbacks too from a tax, especially if you're, if you're accelerating depreciation and things like that. So I'm curious to, what's Michelle's long-term plan within the space at all?
Definitely expanding real estate. I'm still in acquisition mode. So as you can see, I have 2 active deals I'm working with, and fantastic team. I adore my team, so big shout out to them. And in terms of, I love giving back. I write about nerdy things like economics and politics. I also look at data, and I've been developing some, putting on my techie hat. I've been developing some tools that I think
Mm.
a lot of operators such as yourself would directly benefit from. Leveraging my mistakes, is your time savings, is your cost savings, etc. And so I definitely see myself helping others, as I mentioned earlier, achieve their fire. I'm committed.
Yeah, that's awesome. Well, there's so many things we could talk about. I could go for another probably all day. And I mean, this has been a great conversation, and there's so many different angles, and there's things I wish we could have talked about more. But in an effort for time, how could people find out more about you? It sounds like you create a lot of great content and all that kind of stuff. So if the listeners are interested to learn more about what you do and get involved and all that kind of stuff, how can they find you?
Yeah, so you can go to Investing with Fire, that's spelled as one word, investingwithfire.com. And feel free to check out, if you go to Insights, there's a whole webpage of reports and analysis that I've done, everything in terms of climate risk scores that I've done nerdily through. I've done the work so you don't have to, one kind of thing. That's all free for you. I love educating my partners and those in my communities, because the more educated you are, I
Yeah.
think the higher quality of work we deliver. Uh, I love, if you're in the Bay Area, we have quarterly get-togethers with Neil Bawa. You might have heard his
Yeah,
name.
definitely.
But yes, so Neil and I put out a quarterly, Bay Area in-person event, and we talk about, you know, nerdy things like where the market's going, if the market is bottoming. And the answer, short, for those people who are curious, is yes, we believe that the market is bottoming, and
Mm.
now is a fantastic time to get in. While you are still able to get some of those great assets. Like Warren Buffett talks about, like, when people zig, you zag.
Mm. Sure.
So, yeah, this is a great time to take advantage of the market. This is a once in a lifetime. I haven't seen it like this.
Awesome. Well, that's a very positive way to wrap up this episode and get everybody excited to learn more and to reach out. So, Michelle, I thank you very much for being here. This was a great conversation.
Thank you. Likewise. And you can also reach me by sending me an email, info@firecapitalgroup.com. So it's a pleasure. Thank you so much. And I look forward to talking with you soon, Peter.
Thanks, Michelle.